All right. We'll go into a general question and answer period. Okay.
Okay. I continue to not have a precise or clear understanding between overlapping value and unchanged value. Can you repeat it? When today's value is exactly like yesterday's value, how do you define or name it? When you have today's value that is outside both of the high and the low of yesterday's value, how do you define or name it?
Okay. The scale I use is overlapping. If it's overlapping, that means it covers approximately the same range as yesterday. Now, you could have one where the value was above and below as well as overlapping. So I would still call that overlapping value. It was still a sign of value. So if I start from the top down, higher value. The next would be overlapping to higher, which would mean some of the value area was in the previous day's value area and some above. When I call it overlapping to higher, there's a fair amount that's in the previous day's range. Overlapping, there's a couple. It could be if it's just inside the previous days, that would be overlapping. If it's, almost matching the high and the low, overlapping. You can take a little bit above the high, a little bit above the low, would be overlapping. So it's not a precise definition. Overlapping to lower, you would have some in yesterday's range and the remainder lower. Clearly lower, there would be no part of the value area within the previous day's value area. So that's kind of the way I define it. The best thing I can say is do it via inspection. Just take a breath, look at the market and say, is the market, when you look at the value, is the value fairly similar to yesterday or is it not? And if it's fairly similar to yesterday, just, go and say, okay, well, it's basically about the same. You look and say, wait a minute, it looks to me like there's more on the upside than the downside. So, value is overlapping to higher. Again, but do it by inspection. Don't look for an exact definition of it. Just take your breath, just take a look and see what you think you see. Let's go back and just inspect a couple.
So they just want to say, so unchanged value is overlapping value?
Overlapping value, yes. Overlapping value would be just overlapping, and there'd be, it'd be basically the same thing. Okay, here, this is overnight in the middle. Let's take overnight out just to kind of make it.
He came back to ask, is unchanged value synonymous with overlapping value?
Yes, it is. Okay. Here's one right here, overlapping to higher. I would call this higher. I'll give you a few ticks down here. Overlapping to higher. I'd call this lower. Yeah, it's a little bit into yesterday, but not much. Overlapping to lower. Higher. Higher. Lower. But you're right. The terms overlapping and unchanged sometimes are confusing. One of the questions that came up quite often, how do I manage a bad trade? And I think if I took the most valuable thing I've ever learned, number one thing I've ever learned, I learned from Marty, who was one of our early clients, referred a lot of people to us, been to many of the intensives. He was I've told this story before. He was a trader on the floor of the New York Merc. He was an oil trader. I'll give you the full story just in case some of you haven't heard this before. He was a rough and tumble guy. Played hockey 3 or 4 nights a week. Big drinker, tough guy, down on the floor. And all of a sudden he fell in love, and he wanted to get married. He wanted to have kids, and he wanted to be home with his kids while they grew up, at least till they got into grade school. And he came to me and asked if I would help him learn how to trade from off the floor. And like I say, he was a successful trader, rough and tumble guy, rough and tumble on the floor too. Very well respected on the floor. And first thing I recommend is don't go all or none. Trade, 4.5 days on the floor, come home, trade a week off the screen, just kind of ease into it. And Marty became a really good friend. He got married, had a couple of great kids. Marty cleaned up his act. Kids, wonderful kids, and trades 100% off the floor. And the one thing that he taught me, he said, and he kind of had this rough talk, Jim, he said, the best thing I can ever tell you is the best trade you'll ever make is getting out of a poor trade. So when I come back, and a lot of the questions say, how do you manage a losing trade? My answer is, you don't manage a losing trade. You get out of the losing trade. I can't think of anything that has messed me up more over the years than getting stubborn and trying to get even on a losing trade or adding to a losing trade. And the second part of that Marty said, he said the problem with a bad trade, it keeps you out of a good trade. And that is so true, because when you're managing a losing trade, you're not thinking about anything else. You're trying to manage that trade to save your ego, everything else. Get out of the trade, get your mind clear, take the loss, get rid of it. Don't look back. If it comes back, so, oh boy, I'd have been better off I'd stayed in that. Take a look. More often than not, you'll be very pleased that you got out, get your mind clean, and then you can go on to the next trade. I would like to see how many people agree with this as they think about it. Think about, how bad, how much pain and suffering and additional losses they've taken from not getting out of a bad trade or trying to manage a bad trade. Keeps you out of the good trade, the next good trade. Let me open that up. Jen, let's see I would like to see comments, reinforcements, or challenges to that comment from people that are out there right now.
People are saying, yep, 100% agree. I agree, but it's not always easy.
I agree.
Losers agree. The hard part is one has to define what is a losing trade based on their risk, correct?
Here, let me stop time. You usually forget the risk. My guess is if it's a bad trade right away. Then your mind goes to other places. Well, let me see, give it some time. Let's see, it comes back. There's usually that little flash that goes through your mind. It's a bad trade. Get out of the trade. Like I say, if I had to take one thing in my whole trading career that I could have done away with over the years much sooner, get out of the losing trade. And the other is adding to the losing trade. It's amazing how many you'll add to a losing trade, and the one time that it works, and oh boy, you make a lot of money. The more times you do that, the greater the odds that it's not going to work. All right, other comments on it. I think this is really, really important. And somebody said, well, it's hard. You're darn right it's hard. It affects everything. It's not just a simple act, getting out of it. It reaches deep into you. Your ego, your psyche, everything's involved. Other comments from that?
Yes. That's the reason why I think options as an alternative to a stop is quite sexy. I have a habit of staying too long in bad trades. I agree completely with Jim and need to work on this. I totally agree to just get out of a bad trade. Um,
Let me make a
Somebody's
comment.
asking,
Hold,
okay, but
hold,
when does a
hold
trade?
on, hold on, hold on. Before you go on. And somebody said, and that's the reason options are sexy. There is another side of an option too. There's a bad side of an option. Oh, well, I'm not going to worry about it because it's not much risk. And it's easier to let that option get away from you. You know, options are, they're sexy when they work. And yes, they do reduce the risk, but they can get away from you very quickly. And then you say, well, I've lost so much on it, I might as well stick with it now. So it's not that I'm going to say the same thing about the option. Get out of the bad trade. Okay, go ahead.
Let me find my spot. Okay, so here's a question that came up with regards to this. Okay, but when does a trade really, when does a trade really be considered a bad trade?
I can't answer that question for you. Only you can answer that question based on the context of which it happens. But my guess is you know. My guess is you know if it's a bad trade. And then the rationale starts. Part of the problem is, and I'm going to guess that everybody's been through this. You've got the bad trade. You know it's a bad trade. And then that little voice goes off in your head someplace. Say, well, maybe it's not that bad. I mean, it is amazing how we can rationalize. We have a tremendous ability to rationalize why it's not a bad trade. The first blush is we know it's a bad trade. Bang, you just know it. And then that little voice says, well, let's see. Maybe it's not so bad. I don't know if anybody feels that. That is the hardest thing I've had to fight. Step one, knowing it's a bad trade. Step two, those little voices are those that we have. If you really start to understand the mind and how it works, it's not your brain isn't one single processing point. It's not like a computer. There's one point you're going to get one answer out of it. There are competing areas in the thought in the brain. And one thing tells you to get out of a trade, and then that other little brain takes over and starts to filter reasons why you don't need to get out of the trade. And it's amazing to separate those two. And, is one of the things that I say, I've said for years, show me a person that can't rationalize, and I'll show you a person that's really crazy. That ability to rationalize why it's not a bad trade. And that's usually the second thought. It's not the first thought. You get to train yourself to understand the first thought. It's a bad trade, get out. And that's easy to say. But that ability to rationalize is absolutely huge. All right.
That person came back to ask, how many adverse ticks should I endure before getting out, though? Can you be more specific? 2 ticks on ES would be just noise, but 4 handles would be quite a lot. I try to pace my stop when my hypothesis is invalidated. For example, one time framing would stop at this level. Is this a good way?
Now, I can't even begin to tell you how many ticks.
There's a lot of things that come into play. I mean, was it a slow trade? Was it a fast trade? Was it a trade where we had a lot more volatility in the market? All those types of things. What are the other contextual clues coming into the day? Like, do you know that we've got poor structure and, for instance, we're way too long or something like that? All those types of factors make a difference in deciding those types of things as well. If you always just have like a set stop, I mean, it just really depends. It really depends because when we're more volatile, your stop is going to need to be wider. Otherwise, you're just going to get wiggled out, right? Things like that.
Okay, here's the most important thing. And it's really none of that. It's all of that, but it's when you entered the trade. Why did you enter the trade? And what were your expectations when you entered the trade? And I don't care if it's 4 handles or two ticks or whatever it is. If that trade's not performing as you expected, get out. For example, a lot of bad trades, you want to get out and you don't even have a loss on it. I mean, I got a lot of trades that I know are bad, that I get into the trade, and I may have got in the trade for very objective reasons. But it's, say, for example, it's a buy and the market starts up. And you say, uh-oh, that's just not here. It's just not here. Whether you're at a profit or loss has nothing to do with exiting the trade many times. So many times we think, we think that a bad trade is a trade that we have a loss on. That's not necessarily the case. You want to come out of the trade on your own. So many times the trade will start to work and it actually be profitable. And you say, wow, there's nothing here. Get out of the trade. Why did you get into the trade in the first place? And remember, if you didn't have a clear reason for getting into the trade in the first place, then you need to turn around and not even take a second thought. Just get out. And we do that a lot of times. When we get into trades like that, we get caught up in the emotion. We get caught up in the emotion. We get caught into the emotion. That auction process draws us in, and we get caught. I think I read something one day. It was sent to us by a client, Amy, and was talking about some guy that was at, I believe it was a cattle auction, and he had no intention to buy what he did. And he said, well, he got caught up in the auction. And that's what happens. And so sometimes, I would say that so many of my trades, I'm out and the trade's not even at a loss. It's the trade's not doing what the trade should be doing if it's going to be a profitable trade. And if it's going to be not a profitable trade, but a good trade. So get out of the thought process that thinks it's not a loss unless I'm losing money. It can be a bad trade and still be profitable. But the most important thing, if you know, it starts with knowing why you went into the trade in the first place. And if the reason you went into the trade in the first place isn't working, get out. Okay, other questions?
In relation to this, somebody's asking, the first thought of a bad trade is more of a gut feeling than an intellectual idea. Is that correct?
Absolutely. Absolutely, positively. When you reach a level of experience, so many times we think we're making conscious decisions. By the time we actually make a decision, it's already been processed in our mind. It's back in that subconscious level. And that's absolutely right. And then you feel that, and that's that little voice that kind of goes through your mind. But then it's hard, you can't verbally rationalize, well, I'm not at a loss, it's profitable. And it gets really hard to follow that first impulse. And that impulse, remember early on, we started this discussion, and I think it was, discussion was honing intuition. And I think I said when I first talked about honing intuition, I contacted emailed my friend, and we're friends, but we don't socialize and stuff like that, but we have other interactions over many years. Brett Steenbarger, the psychologist, the trading psychologist. And I said, am I going to get torn apart if I start talking about honing intuition? He came back and he said, absolutely not. And he made some references, gave me some references to look up. I don't remember what they were right now, but I was assured that I wasn't going to get cut up by the psychological world. And then if you think about it, what is experience? If I have no experience about something, and I may make bad decisions. Intuition isn't something that we are necessarily born with. It's something that we learn. For example, I know I've used this example over and over again, but the first time I went off the ski jump, everybody told me that when I'm going uphill, that wood on water had less friction than going straight flat on water. Yeah, they told me that, but it really wasn't in my mind. When the first time I went off that ramp, I lean back, and of course the skis are going faster. They go up, out, and I land on my back and bounce, and it hurt like the dickens. Second time I went off the jump, I made it, because now I believe. What happened? Well, now my intuition was honed. It only took one time of a lot of pain, but my intuition was overridden by fact. The intuition changed. And so what happens? The more experience you get, and Jen uses a word that I love. She uses the word layering. The more experience you get, you put that experience gets tucked away in the back of your mind. And then you work on the next thing. And what was interesting, reading the book on the brain, some of those intuitive thoughts, guess what? Guess where they're stored? Who read the book? Who remembers where some of those thoughts are stored when they get really, you really learned something. Anybody remember where it's stored? Any answers? I mean, I use this as an example of how deep this experience can go sometime.
Subconscious?
But where where's it stored? The answer is in the spinal column. Not in the head itself, it goes in the spinal column. The brain isn't just as simple up there. That's how deep some of these things get stored in there. So, and that little, when they're stored that deep, when they become that intuitive to you, you make that decision long before you verbalize it. So I don't know if that makes any sense or not. I was going over all the questions and the things you submitted today. And back to Amy again, I got a long response from Amy, and she remembered I said, early on when I used to talk about the brain and synapses and stuff, that synapse, people kind of close their mind. She said, keep bringing it on. It's very valuable. And I think it is. And we've been talking more and more about that in recent intensives. So again, you get the experience and you just keep building it. And then you get that feeling inside of you. And I know I'm beating this to death, but the point is that, one, a lot of times a trade doesn't have to be at a loss before it's a bad trade. And a lot of times that, and then it turns into a loser. And then when it's been a winner, at least profit-wise, and then it starts to go and have losses, sometimes you get even more stubborn because you didn't take it. You couldn't get out of the trade when you could have gotten out of profit. And now when it goes down, you get even more stubborn. And you understand, I'm only doing this from what other people have told me. It's never happened to me. All right. I probably beat that to death, but let's go ahead with other questions.
Pick it some more. No. Okay. Okay. Let me see here, because we've got a lot of different responses. Did you still want me to read off some of what?
Sure.
What
I think that's good for everybody. And there's not a one of us that doesn't suffer from that bad loss syndrome, I don't think.
Somebody said, agree totally. It drags on your mental reserves and capital, messes up your mind going forward for next trades, which you've definitely said so many times. Let me see here. There were several things here.
Well, before you read the next one, if, a lot of questions for what do I do? What do I do following going forward once the intensive's over? Well, I would say if this, you kind of make a list of things you want to look at. And if this trade thing is, put that right on the top of your list, that right on the top of the list. Continually remind yourself till it becomes a habit. All right. Other responses.
And
Other
not only
questions.
that, I would recommend that if there are, some concepts and stuff that you know that we covered and that you didn't quite get them or understand them, go back and watch the videos. Really, going back to watch stuff, you'll find that you pick up stuff that you didn't before. It'll solidify things that you weren't sure of before. Lots of things like that. And you'll also pick up the contextual pieces too while you're watching them. Somebody was saying, what I found that really helps for entry is to use what we've been taught and first define. Where would the trade be truly wrong? Like, for example, we shouldn't break back into yesterday's range. Set the stop first. And this really eliminates all the late and bad entries because by definition, you see that you're taking too much risk.
Okay.
Um,
And before you enter any trade, you should know where you would be wrong on the trade. A lot of times, everybody throws out a risk reward. It's easy to throw out risk reward. And somebody says, well, yeah, I had good risk reward. I'm only going to risk $2 to make 10. Well, that makes no sense at all because you just pulled that one out of thin air. You got to look at the market and say, okay, if I'm wrong on this trade, what happens to it? And then you say, okay, so immediately some idea of, if you only have to go down, say, back 2 handles into yesterday's range, okay, so you got a $200 risk on the trade. Is it logical, looking at the structures, that logical could go up 5 or 6? So again, risk reward isn't because I'm going to risk 2 points to make 6 or whatever. It's because you've looked at the market and you got some idea of if this trade doesn't work, where you would be forced to get out. All right, other questions? Or continue on this discussion. I mean, I've never known anyone, as long as I've been around, that this isn't a very serious issue, this issue of handling losses.
Yep. Somebody was mentioning, I don't think the risk reward idea is helpful at all. It can really screw you up.
It's that's an interesting. It
keeps you in
comment.
way too long most of the time.
That's a very interesting comment. Because I generally agree with the comment. If in fact you're just thinking in terms of dollars and cents. If you're thinking in terms of, as we talk about thinking in bets, the question of, a lot of times the question comes up, does this trade have a good chance of working? Rather than how much could you make? Does it have a good chance of working? If it doesn't have a good chance of working, thinking in terms of bets, then your risk reward's not going to be attractive. Rather than putting it in a dollars and cents sign, it's say, okay, does this trade have a good chance of working? And, is there a spot where I know within a relatively tight range that I'm wrong on the trade? That's a different way to look at risk reward rather than to think about it in terms of dollars and cents. I don't know if that makes sense, but I understand exactly what you're talking about. And I've thought about it many times. It's looking to say, does this trade have a good chance of working? And if it started to work, could it be meaningful? And well, can I know very quickly if this trade's not working? And there's 2 ways to know if a trade's not working. One is looking at the trade and saying, okay, I don't want to go back. If this trade's going to work, Jen used the example earlier, you look above yesterday's range and you certainly don't want to go very far back into yesterday's range. That's one way to look at it. Another way to look at a trade is, remember, price advertises opportunity, time regulates all opportunities. And another way to manage the trade is when you put the trade on, you really want the trade to start to work fairly quickly. If the trade doesn't start to work fairly quickly, you probably want out of that trade. Okay, now I'm going to go off in another direction. Because right now, the discussion that we're talking about right now is very fixed. It's in this term, okay, I put this trade on, I risk this much, I get out, and okay. But I do something different. And when I use options, sometimes I may see a situation in the market developing, and I'm saying, I don't really, this market's kind of crazy going in up or down, and I think the market's getting overly done. So I may start to work into the position with options. So maybe I say my position is going to be 3 when I'm done, and maybe I go in with 1 and then 2 and then 3. And it's not uncommon for, the first 1 or 2 to be at a loss. Then I add the third one and the trade works. That is different than this thinking of, I get in here, the market either goes up or down. I'm watching the market move and I'm thinking that the market is getting really overdone. Or I think the market's getting up and it's getting ready for a breakout. And so another way to think of it is, if I go, think about if I'm looking at a trade and I think the risk reward, or I think it's becoming attractive, and I may work into the trade, and I may be willing to accept that, a couple of my options are going to be at a loss at first, but I've made that judgment ahead of time. When I make the judgment ahead of time that I'm going to work into a position, that is entirely a different situation than I'm into the trade and then I add to the position, because it's not working. Those are two entirely different. Adding to a losing trade is one thing. Starting to build a position in something, because I think the market, I don't know exactly where it's going to, be overdone, but I think it's getting there. And working into the trade with that idea ahead of time, that's a totally different situation. Okay, did I totally confuse anybody?
No, I just think this is an excellent discussion and one that people should revisit again, or, just to hear it and maybe even just write down some main points to keep in their mind moving forward.
Okay.
Back to the person who had asked the question before about the stops and things like that. They came back to say, I would like to clarify my point. The first thing I put on is the stop, according to the scenario I think would work. Then I assume my target. Finally, I adjust the number of contracts according to the financial risk that I accept. What do you think about this?
Well, let me ask you a question. Is that working for you?
Okay, they came back and said, it secures me.
That's different than is it working? It's, remember, sometimes the best trade will fly in the face of the most recent market activity. When I put some of those trades on, I don't necessarily feel secure. And that's why I'm coming back, and asking a different question. And sometimes, there's sometimes I have, a lot of nervousness around a good trade because it is going in the face of the most recent market activity. Security, feeling secure, isn't necessary. Feeling confident is different than feeling secure. So my trade, it may make you feel secure. Is it producing profitable results? I think that's really the question. Keep in mind, trading is a business. We buy inventory, we sell inventory. Sometimes if I'm running a retail store and I have something in my inventory that's working very well, I may mark that inventory. I may increase the price because it's a good item. It's selling very strongly. Other inventory isn't moving. I've got to get rid of that inventory. Trading is a business. I have inventory. I buy and sell that inventory. I build inventory. I liquidate inventory. I'm concerned with cash flow. I'm concerned with profit and loss. It is a business. So if in fact if you're feeling secure but not profitable, then you need to challenge that idea. Then I'm going to come back and say that's not working for you. It may make you secure, but it's not giving you profit. Then it's got to be reevaluated. Okay. We can keep coming back on it. It's an important issue. Okay. My best advice to anyone is when you go into a trade, you should have some idea of what would tell you you're wrong on that trade and what can happen if the trade starts to work. So you have some idea. Like I say, a lot of times I'll be out of a trade that's working, that's profitable, but it's not working. Being profitable and not working they are different things. Okay. Other discussions or continuation?
Yeah, so somebody was saying the ability to sit with uncomfortable feelings is something traders have to learn. Does Jim agree with this statement?
I do, as long as the reasons you got into the trade are not being violated. It may not be working up price-wise, but it's not really deteriorating. Yesterday was just a wonderful example. This coming down in the morning, I knew that we did not correct overnight inventory, sign the market's weak. Value was building lower, sign the market is weak. This market's coming down. I put out 2 posts that said, be careful, the market's not getting too short. The trade was working, but I was terribly uncomfortable with the trade. And this trade worked, and it worked big time. I was terribly uncomfortable. In fact, more uncomfortable than I usually get in here. Okay.
One of the greatest limits that Market Profile has is to not show the open and close of any period. So you do not know if during a period the market was up or down and many other important details. This is like a puzzle for finding the right interpretation of what happened during the session. If you are away from the screen even for an hour, so I have to constantly go back to watch the open and close of previous periods and other time frame charts like the 30-minute candles or the 5-minute candles to see exactly what happened at specific references. This is very time consuming. How can I solve this problem?
Okay. I'm going to bet that your trading is not successful. And I don't mean that to be argumentative. Just from my experience, you're focused on very short time frame pieces of information. And I'm going to bet that you really haven't gotten to the point where you get an idea of the larger picture that's going on in the market. Probably keeping other technical tools, and that's just my observation. I actually think it is a real plus not to show the opening of the bar, the closing of the bar, and all of that information. It's too fine, it's too small of information. And I think it will do far much more to distract you than it will to help you. I would love to see comments from other people about the issue that we're discussing right now.
And I will say I was one of those people that had all that stuff on there, and Jim told me to dump it. And it was a very hard transition period, but finally I did because I wanted to commit, and that was the best thing ever for me. So
what I've said is, if what you're doing right now is working and making you profitable, then you don't have a need to change. If what you're doing is not working or not giving you satisfactory production, then you need to reevaluate everything you're doing. And the things you're looking at and the questions you're asking, they are in no way related to what we do. So anyhow, it's just I would love to have other input from other traders out there.
yeah, we have some comments here. Tempo and confidence are way more important than the open and the closes. Opens and closes create dissonance, especially the candle wicks. The more I kicked out, the better, and the more relaxed I felt. Now I'm just focusing on the profile. And I have to say, yeah, I agree with all these comments, because I used to have 5-minute, 3-minute, 1-minute charts, all that kind of nonsense on my charts, and ended up getting rid of all of that. And I during that transition time, I kind of made excuses for myself, like, oh, this helps with entry or something like that. But no, it doesn't. When you strip away everything and you're at the heart of what's really important, which is observing what's happening, the context surrounding the situation, but then you're watching the market carefully and observing how it's doing it, things like that. That's just more important, because if you have all these other technical indicators or charts and things like that, 5 minutes, it's very distracting. You're going to end up watching those more than watching the actual market and what it's doing. Like, how did it get there? Was it confident or was it choppy? Was it a swift rejection, or what's happening? How did it react at that reference? All those types of things. You're going to miss those things if you're looking at other things.
What do they say about how many pieces of information can the market hold, can the mind hold at any one time? It's a limited number. So you have to be selective about what is it. What are you really going to focus on? And I come down and say you're focusing on the development of value. Let's take what was important yesterday. Relationship of the market to overnight inventory. Gave us a big clue right there. The market overnight inventory was long, and the market didn't care.
Okay. I duly note the weak structure left above, but do you view the 1 tick open gap below as still a gap? I'm carrying this forward from last week as a weak low still. Do you agree or disagree?
You talk about the
2684.
Yes. Yep, it's still weak. Now, we haven't taken all of that back, but okay, this is a single data point. Okay, but now when you add this data point with all the other data points that we had, and the market's come back and taken a lot of that out. So if it doesn't go back and take out that single data point, that can happen. But when you add that together with all the other weak references we had last week, and that's what we got yesterday. Whether it's over or not, I don't know. It could still go down and take out that one single data point. But remember, that was only one. You combine that. When you combine one weak data point, like the single tick gap, with all the others, it got to the point where the odds were so great that the market was going to come back down here, that it was really, it was just very, very good odds that we would come back down here. Now, the fact that we've cleaned up a lot of that lessens the odds that we have to go back down and take the single point. It's still a weak reference. We may go down there, but it's lessened because we corrected so many of the others. There's not so many cumulative references. All right, go ahead.
Okay. When price was going down yesterday, why did the value area high go up?
I didn't notice it. But it would be the reason, well, the value area didn't high go up, but it didn't go down proportionally, I guess and that was because you were getting less volume on the lower end than you were on the upper end. Remember, the value area is calculated on volume, price and volume, time. So if that happened, it was just not as much volume on the lower end as the higher end. I didn't notice it. Okay, other questions?
Yesterday was another one where the right trade was to stay short and hold on. There was a balance and lack of conviction early on, but eventually it started heading down. We've learned to be concerned when there is a huge tall range of single prints, and so maybe we should roll down puts or have a trailing stop on a short future. But overriding that, it seems that it was most important to be involved and ride the run down. Comments on that?
Let's talk about what happened yesterday. Again, this was to me, a very common, technically driven trade. We already know that the 200-day moving average, which is only one of the very few technical indicators I follow, simply because there's so much emotional interest around that level. So the market came down, it filled the gap one, and then it was trading, it was down below the 200-day moving average. And remember what I said, big traders a lot of times will not have a position on the upper side of the market. They will put their positions on once the market has broken through that reference, because now they see it as a new trade. They know that this is the high risk area, that you need to get through this level first. So a lot of times what they will do, they will have covered their shorts before you get to this level, and then they'll put them back out on the other side. They see the risk as high. If they're short here, they see the risk as high, because if it doesn't get through here, you can get a heck of a rally to the upside. Once it gets through, they see their risk of being short as being very low, because you've come through this reference and you're into new area now. So that is something that is very important when you're near large areas. If they're not always there, but if the larger traders are there, they will be flat on the upper side and they'll put their trades on the lower side. A couple of reasons for that. And they can put their trades on in massive size because they know if it doesn't get extension below here, gets back above this, that it's not a good trade. So they feel very comfortable in trading really big size there. And they understand that, that there's already longs, they can figure there's already longs in this market. We're talking about not day traders. We're talking about people, that big pool of capital that lies in between the day trader and the institutional long only or, big investment money. There's huge pools of capital that can come to work, and it's usually very leveraged. So they don't have any position up here. They put on huge shorts down here. Okay, so that's what's going on. So one, just take it a step at a time. What has happened before has a lot to do with the potential going forward. So they saw this market going forward as very long, very weak, but they follow the price. Remember, momentum trading goes till it's over, and when it's over, watch out, because it gets turned around, and they don't turn around immediately. It usually takes some to put the pressure on. So one, inventory was long, and it was long, and it was weak hands. Weak hands inventory, and it was very long inventory. So we got the gap on the weekend. The market didn't even come close to tagging that gap. Then you got below this. You can't. It's higher value this day, but it was well below the over the Sunday high. Then yesterday, as we said, you started the pressure early in the morning. Didn't care about overnight inventory, and the market got down, and all of a sudden, it was a terrible, terrible effort to get through here. Then once it got through, the bigger money is shorting right here. And they short in size, and they add to those shorts. Okay, so that's what happens from a trading standpoint. Other questions?
This one was asked earlier with regards to, you know, when we had answered about overlapping value and the value question. So another person came back to ask, overlapping can be inside, outside, or unchanged? They wanted to clarify.
Yeah, overlap. Well, you know, if it's clearly within yesterday's value area and it doesn't hit the high or low, I'm just going to call it inside value. If it overlaps minor on one or two sides, I'll still call it unchanged. If it overlaps on both sides, but it's minor, I'll still call it unchanged. You know, I mean, it's going to be an easy visually if it's overlapping to higher, overlapping to lower. It's going to be visual. You'll see that there won't be a lot of question. Is it overlapping to higher or lower, overlapping to lower? Okay, other questions?
Okay, 1 second. Okay, day reversals. Some are obvious, at least with hindsight, like Monday's or Tuesday's 7-week high area. But last night and today's 16-point reversal back up isn't so obvious to me. Would you say yesterday's 30-minute inside bar at 3:30 p.m., a balance bar, and the official end of the Would you say yesterday's 30-minute inside bar at 3:30, a balance bar, and the official end of the downward move? Would you consider that the end of the downward move, I guess, is what they mean to say?
No, not necessarily. But, you know, sometimes the market gets too short to go any lower, and it has to rally in order to bring inventory back in line. I mean, we have that all the time. So much of trading has to do with rebalancing inventory. So the trend may be down, but you may get some rallies that rebalance inventory. And sometimes that rebalancing is just among day time frame traders. Other times that rebalancing is among, you know, much longer time frame traders. So, you know, it's but it's something over, you know, balances inventory rallies and breaks are constant throughout the market. Now, was that the end of it? I don't know. I don't think that last night's bounce is totally unexpected. Remember, this thing was 36 handles a single prince. That is highly, highly unusual. So we've got, when the market goes this far, and that's all those single prints is a sign that it was just strictly emotional trading. And emotional trading has a tendency to see reversals or at least sharp inventory corrections going forward. So no, last night's is not unexpected to me. I think the market just got so terribly short. And a lot of times what you get late in the day when you have something like yesterday, you get people that are forced liquidation. They have to get out of trades. And you get other people that just say, boy, they're going home short. Okay, other questions?
Yes, 1 second.
A fuller answer to the last question. It's contextual. When the market gets as short as it got, as many single prints as it got yesterday, it's not totally unexpected that you get a rally once the emotion is out of the market and people, the emotions calm down and people get a second thought. So it's not last night's rally is not unexpected. Okay, I'm sorry.
Okay, 1 second here. In yesterday's trade, I saw the potential for the market to fill the weak FGH distribution at 30.75 and bought. But the market started stalling out at the top of I and J, and I sold. The market sold off again, but came back quickly and repaired the distribution at K. Can you help me understand how to monitor for continuation when the market stalls out and bounces back? Is it simple enough to say that when the market doesn't get up in one pop, it's not a sign of strength?
Taking this example, I mean, yesterday, you're not going to see it yesterday very often. The market was just crazy on the downside. Then you got a rally in, you made the I period low, and you got the rally in IJK, and then the traders were selling. They got the inventory adjustment, and then the traders were selling. Traders were selling again. They were selling all rallies. So to expect a big rally yesterday, when you have 36 of prints in that late in the day, the odds are low. It's not unexpected for traders to sell rallies on a day like yesterday, and it's not totally unexpected to come down and close on the low. So this rally in the inventory adjustment you had in I, J, and K, and followed by a further break isn't unexpected on a day like yesterday. I mean, we see that quite often. If you're saying, well, it's so far, you need to go long, it's a bad day to go long. I mean, some people got lucky and there were some pretty good bounces in there, but the trend was down. It was a downside breakout. You're always better off just to go with the breakout, or stay out of the market if you don't feel like it. But it's rare to get a total reversal of a day like yesterday. Okay, and it's not uncommon to go down and close on the low. Remember what I have said about trend days, and yesterday was a trend day. Yeah, the rally was more than you get on most trend days, but remember what I said on trend days. Who remembers what I said about trend days? Let me see some answers. Be thinking about the answers. This helps kind of solidify it in your mind. Any answers?
Don't fight one time framing. Don't pay attention to the POC. Go with the trend. Don't fade. Don't step in front of a trend day.
What else did I say? How many times have I said on a trend day, it is not uncommon late in the day to have an inventory adjustment where the market stops one time framing, followed by a reversal closing on the low, or even downward range, additional range extension. On a trend, I'm going to repeat it. This is something that, first of all, the worst thing a trader can do in most cases is fade a trend day. More losses are taken from fading trend days because whether it's a get even trade, you didn't short it early if it's going down, so you're going to show them they're wrong, but you don't fade a trend day. But I've said so many times, it's not unusual on a trend day for the market to stop one time framing, one time, preferably late in the afternoon. I see the inventory adjust and then turn around, trade back down, and sometimes even extend and finish on the weakest side of the market. That is a very, very common type of thing. I don't know what I said in there, but Alexa decided to answer. Okay. Next question.
Yes, 1 second. Oh yeah, with regards to what you were just saying, somebody was saying that is to let inventory rebalance. That's why I was asking Jim yesterday whether he thought that inventory had been corrected, because I thought that it had.
Okay. I'm sorry, I didn't understand the question. Corrected versus rebalanced. In my mind, maybe they're the same thing. Rebalanced connotes to me something different than inventory being corrected. You can get the market to rebalance the inventory. It's still going to, on a day like yesterday, it's still going to be short, but it just allows the excessive shorts to get out, and then the market goes back the other way. Corrected, in my opinion, corrected would be it went all the way back up. Rebalanced just connotes something different to me. And we may be playing with symmetry here. So I'm sorry that I didn't totally understand the question. Yes, it's not uncommon.
That it makes sense.
Yeah, okay.
I was just going to say, with regards to trend day, maybe you could, I mean, and not necessarily that point that you were just clarifying, but that a trend day market, like one time framing, a trend market tends to balance for a couple of periods to adjust the inventory and then continue the trend, or you can say it stops one time framing, one time. You don't want that. It's a stopping of one time framing to become the focus. It's something you pay attention to. It could be where you could hop on the train, even, that type of thing.
There's other context here.
Yeah,
if it's a trend day and it stops one time framing too early, say it 3 hours to go, that gets my attention. It's not really a strong trend day. The trend days I'm talking about are when they stop one time framing relatively late in the afternoon, rebalance inventory, then they continue. And the reason this sticks in my mind so much is the huge losses I took, over the years. Because all of a sudden the one time framing stops, you missed the trade to begin with. Boy, now you got to show them. Market starts up, you think that's it, and it's really embarrassing when you buy the high of the rebalance, and the market turns around and just kills you on the downside. So again, I learned all of these things the hard way and at the expense of a lot of money. And you don't do it one time and learn. It usually takes you multiple times to figure out what's going on. Okay, other questions?
Okay. Could large traders liquidating be the reason why the market re-entered the previous range multiple times before breaking?
Well, it didn't re-enter the previous range multiple times before breaking yesterday. It had trouble getting into the previous range. Then it broke. The reason I think it had trouble getting into the previous range is you had a lot of short-term traders buying mechanically just above the 200-day moving average. They were buying as close to the 200-day moving average as they could get. Remember, this market went up. I think it was on Friday. We had 5 areas where we had exact references, which is a sign of very mechanical buying. So now we get down yesterday, and I think there was still that buying as you got down near the gap, filling the gap, which would take us back into the previous range. And then once it got through, and like I said, the big traders, they put their trades on when actually there's more assurance that the break is on the way. Okay, what else?
The 50-day moving average is now below the 200-day moving average in the S&P, NASDAQ, and Russell. Doesn't this show more acceptance at lower prices? Does Jim have any comments from a historical perspective?
I don't follow the 50-day. The only thing I look at is the 100-day and the 200-day. simply because there's been so much trading there. But overall, the market, I think the answer to your question right now is we've got the weekly bar chart, and we failed at the top, and now the destination trade is the lower extreme of the 7-week average, of the 7-week trading range. Now the question is, do we get continuation? Do we get continuation from yesterday? Or was that just a case where the market had gotten crazy long last week? Yesterday could have been a liquidation that then allows the market to trade higher. So that clearly has to be a potential. I'm not saying it is. I'm saying when you talk about potential options on a daytime frame, we say sometimes the market, has to break before it rallies or rallies before it breaks. If you're looking on a larger auction, that same thing can happen. So we may have, it failed to go through the high of the 7-week trading range because last week was just so terrible in the way the market went up, and the inventory was so weak. It may be a case where the market had to rally before it can break. Now we don't know that. We don't know that yet, but it's certainly an option that you have to consider. Rather than, and what I'm trying to say is what some people will do, they'll see yesterday's break as being so hard that they now can't get out of their mind that the market's going lower. And it may, okay? It may. But they can't get out of that mind. So they've now got this bias. And what I'm saying is open up your thinking. It may go lower, and it may just been a break to liquidate before we go higher. Again, ideally, if you want to be a good trader, if I were to say, I had you all in a room, I picked two people, and I said, you're going to argue the upside, you're going to argue the downside. You should be able to do that. Even, you should be able to argue why it would go up, argue why it would go down. You should be able to switch sides and take the other argument. All I'm saying is constantly looking at the possibilities, being alert in the market. Okay, other issues.
Yesterday, I got long with calls at the re-entry of Monday's range at the low and B period. It was struggling to go higher. It seemed choppy on the way back up. I got out after the third or fourth attempt of...
Now, hold on. You got long with calls yesterday
at the re-entry of Monday's range at the low and B period.
Okay.
Okay. It was struggling to go higher. It seemed choppy on the way back up. I got out after the third or fourth attempt of re-entry into Monday's range, and there was no real lift. Was I reading it right, or was I lucky? I made $32, 32 whole dollars on my 10 SPY calls. I know it's a hindsight question, but I'm just wondering. My point was that it seemed to be not doing a good job on the rally.
Oh, yeah. I mean, well, first of all, to buy calls when the market ignored the overnight inventory.
I'll be back in 2 minutes. You can continue, Jim. I'm just letting you know.
When the market, well, there's a couple of things to your answer. First of all, to buy calls when the market ignored the overnight inventory. It's a sign that the market is weak. Secondly, in B period, we are down below the value area from the previous day. Okay, here's the B period high, so we're clearly below the value area. So to buy calls when you've had both of those signs that the market is going lower is a risky proposition. First, if you are going to go against the trend, and yesterday's trend was down, one time framing lower, then you have to be right very quickly. If you're not right very quickly, you need to exit the trade. And what I continue to say, if you understand how to monitor for continuation, there's a lot of trades you can do and you're not going to get killed on them. So if you bought the calls yesterday and you're monitoring for continuation and you're saying you're not getting the lift, you're still one time framing lower, okay, then you did nothing wrong if you that monitored for that continuation, and that's the reason you did it. If you just did it, if you just got into the calls simply because price was lower and you wanted to bounce, you thought you'd get some rebound on it, then it's a bad trade. So the first thing is, why did you get in the calls? And the second question is, were you lucky or were you monitoring correctly when you're monitoring for continuation? And I can't answer that because I don't know your full thought process. But those are the things that, those are the way that you need to be looking at it. Okay, go to the next question.
Okay. Is there a way to assess how long we wait before we can say the market is ignoring the overnight inventory?
No. Yeah, there's no formulatic or rule for that. You look and you say, well, man, first you see the single prints, then you see value, and it gets pretty clear that it's ignoring the overnight inventory. But it's not a science. But it really kind of starts early on. If the market early on, the market didn't care about overnight inventory. We were watching it, but the market didn't care. Overnight inventory was short. Overnight inventory was 100% short, and the market didn't care. It didn't rally, no counter auction, and we said that's a sign that the market's weak. But there's no answer. There's no single time. Jen used a word a little while ago, observation. You learn, the first thing is important, is somebody puts the idea in your mind about the importance of monitoring overnight inventory. A lot of people, including a lot of professional traders, didn't even know it. Well, then after somebody puts that idea in your head and you start observing, there's that word again, you start observing, and then you kind of build your own database and the variations from it, and you're putting into your mind and your intuition. It's one of the questions that I saw that I was going through the questions and the comments you all sent in was, how do I use volume? Do I look at the half hour volume? First, I looked at the volume overall. The first thing I do when I'm considering volume, is there a direction? Volume is really only relative, the total volume is really only relative to me when there's a clear direction to the market. If it's a rotational market, I don't use volume because you're not sure what the market was trying to do that way. So if you make the wrong error on volume, you could be double wrong, because say you thought it was trying to go up and it's actually trying to go down, then you've really set the information against you. So I only use the volume when it's the total volume, when it's clear what the market was trying to do. I don't do any regression of that thing. I don't try to say, well, what is it overall? I just kind of keep it in my head. What's it been in the last few days? And, and I know that 280 is really low. And I know when I get over 4, it's really high. Then the question was, do I use the volume on a 30-minute period? Yeah, I glance at the volume. I do want to see the volume every 30-minute period. But also within that, I will, if I see some areas that are getting a lot of volume, and I said, was the market trying to go up or down when it got all that volume? So I will go to that level. And you notice that the profiles are color-coded, white being the lightest volume, pink being moderate, red being heavy. I do look at the pictures, the colors on the profile, just to give me a better idea if we're picking up volume on the downside or not, or picking up volume on the upside or not. All right. Other questions?
If you don't use the initial balance, why do you have it on your screen still. I said that's the way WindowTrader has it programmed.
Yeah, because they've just never changed it. Understand that I don't use the exactness of initial balance. Initially, I think it was described as the range in the first two periods, but I still looking at the profile to say early on, is the range, narrow? Is it wide? And I know that the narrower the range, the easier it is to get knocked over. The broader the range, the harder it is to get knocked over. So I still use the concept. Remember, what I say is the exactness kills. And I got away from that. So it started when I first started to learn. Pete taught initial balance. And then as I got more experience and observed, I said, that's really not that helpful and sometimes misleads me. But the concept of, is the platform wide or narrow is still with me. Okay.
Okay. 1 second. Okay, one more question here. I think the amount of time it takes to see what does the market think about the overnight inventory depends mostly on current business first. For example, the spike or the gap are specific cases which influence the way the market might see the overnight. Except for a spike, gap, or double distribution, could you say what the main other current business affairs which can take precedence over a counteraction? I guess with regards to inventory adjustment, overnight inventory adjustment.
Sure, you could get an economic report or release. We got a big one coming up Friday. You've got ADP tomorrow. You could get it's run the economic thing, but second period, somebody coming down making a speech. So there's a lot of things that can come into the market to, just any kind of comment can really set the market off at any point in time. Remember, the market's very emotional. So many times people really want the market to be more orderly and they want it to be more scientific and more exact. It's not. It's so driven by psychology. And you saw a great example of that yesterday. So, anything can change and become the current business. All right. Thank you.